What led to the downfall of Silicon Valley Bank? A question that has intrigued finance enthusiasts and common folk alike. Let's delve a little deeper into the initial issues that sparked this financial catastrophe. The first visible crack in the foundation appeared when customers, in a state of panic, attempted to withdraw a staggering $100 billion from the bank in a single day. This mass exodus of capital was a clear sign of eroding trust in the institution's stability. The leadership of the bank came under harsh scrutiny, with critics pointing fingers at their mismanagement and inadequate risk management. In a world where the right decisions can lead to immense prosperity, the wrong ones can equally lead to a swift and brutal downfall. The Senate Banking Committee hearing shed more light on the issues plaguing the bank. It was revealed that the bank's leadership had failed to properly manage risk, a critical function in the world of finance. This was not just a failure of one bank, but a glaring example of the consequences of inadequate oversight in the banking sector. Federal regulators, recognizing the gravity of the situation, launched an investigation into the causes and how to prevent similar failures in the future. Public assurance was given about the safety of the banking system, with the regulators agreeing that banking rules needed strengthening. Yet the question remained, what could have been done differently to avoid this disaster? In the aftermath, the regulators considered taking action against the individuals responsible for the bank's collapse. This included clawing back compensation and imposing penalties, a stern reminder that those at the helm are responsible for steering the ship through stormy seas. The bank had been thrust into a crisis of confidence, but this was just the beginning of the downfall. The collapse of Silicon Valley Bank sent ripples of concern through the markets, with echoes of the 2008 financial meltdown. It's interesting, isn't it? How history tends to repeat itself, or at least rhyme in some strange, unexpected ways. When Silicon Valley Bank, a titan of the tech world, went under, it drew immediate comparisons to the fall of Bear Stearns, the first domino to fall in the financial crisis of 2007 to 2008. Bill Ackman, a billionaire hedge fund manager, was one of the first to draw this parallel. It's a chilling thought, isn't it? The possibility that we might be on the precipice of another financial disaster. But just as quickly as these concerns rose, reassurances followed. Deputy Treasury Secretary Wally Adeyemo stepped up to the plate, dismissing fears of a broader banking meltdown. His words were a balm to the market's fears, assuring us all that the banking system was healthy, that the collapse of SVB was an isolated incident, not a symptom of a larger systemic issue. Yet the downfall of SVB wasn't without its causes. The rapid increase in borrowing costs, a sudden surge that caught many off guard, was a significant stressor. The bank also faced problems due to the decline in the value of bonds it held. When the bank needed to raise funds quickly, these depreciated bonds became an albatross around its neck, a burden that eventually sank it. Through it all, a valuable lesson emerged, a bitter pill to swallow. The banking system, although deemed capable of withstanding shocks, isn't invincible. The collapse of Silicon Valley Bank served as a stark reminder of the potential risks lurking in the financial world. It brought back echoes of 2008, a ghost from the past whispering warnings into our ears. While the banking system was deemed capable of withstanding shocks, the SVB collapse served as a stark reminder of the potential risks. As the dust settled, the blame pointed towards SVB CEO Greg Becker, who had publicly acknowledged the bank's financial troubles. This candid admission, made before securing necessary financial support, was like throwing fuel onto an already smoldering fire. The result? A full-blown panic among customers, leading to an unprecedented withdrawal of $42 billion. The bank's employees, who had been navigating the turbulent waters of the financial crisis, were left feeling betrayed and frustrated. Their anger was not just directed towards Becker, but also towards the management's decision to distribute bonuses shortly before the bank's shutdown. This decision, seen as a misguided move, only added to the growing discontent among the workforce. The situation was further exacerbated when SVB ended the day with a negative cash balance of $958 million. The bank was sinking, and fast. But the question was, who or what had caused this iceberg to appear in SVB's path? Critics pointed to the Federal Reserve's interest rate hikes as a contributing factor. Higher interest rates can increase the cost of borrowing, putting additional pressure on banks. In SVB's case, this pressure proved to be too much, leading to the collapse of the bank's financial structure. However, the Federal Reserve's actions were not the only culprit. The mismanagement of SVB's balance sheet and strategic errors were also cited as causes. It was clear that the bank had veered off course and the leadership was unable to steer it back in the right direction. The downfall of Silicon Valley Bank was a sobering tale. It was a tale of mistakes made, of naivety, and of a lack of foresight. But as the story unfolded, it became apparent that there was more to it than just poor decisions and unfortunate circumstances. While the downfall was attributed to mistakes and naivety, the question remained: could this have been prevented? The answer to this question may not bring back Silicon Valley Bank, but it can certainly pave the way for a more secure and stable banking industry in the future. The downfall of Silicon Valley Bank was a wake-up call for the banking industry, prompting a closer look at finance regulations and supervision. This unfortunate event has shed light on the vulnerabilities within the banking system, highlighting the need for reform. The collapse of SVB has triggered action from lawmakers and federal regulators, with a commitment to investigate and hold those responsible accountable. Indeed, President Joe Biden has made a vow to ensure this accountability, promising to strengthen the oversight and regulation of larger banks. This implies a potential overhaul of the banking rules with a focus on risk management and the conduct of board members and executives. Further, the incident has sparked a discussion on the significance of effective leadership and the consequences of its absence. It has underscored the critical role that sound decision-making and strategic planning play in the banking sector. As we reflect on the collapse of Silicon Valley Bank, one thing becomes crystal clear. A bank's success is not only dependent on its financial capital, but also on its human capital. The right leadership can steer a bank through turbulent times, while mismanagement can lead to its downfall. The collapse of Silicon Valley Bank serves as a stark reminder of the importance of strong leadership, effective risk management, and stringent oversight in the banking industry. As we stand on the precipice of a potential new era in banking, the downfall of Silicon Valley Bank serves as a cautionary tale. It underscores the importance of strong leadership, effective risk management, and stringent oversight. The banking industry has been shaken to its core, forced to reevaluate its practices and principles. The lessons learned from this incident offer a roadmap towards a more secure financial future. As we move forward, the industry must focus on cultivating a culture of responsibility and accountability. Banks must prioritize risk management, ensuring that they have robust systems in place to identify, assess, and mitigate potential risks. They must also foster a culture of transparency, with clear lines of communication between employees, executives, and stakeholders. Furthermore, the role of leadership cannot be overstated. Leaders must be held accountable for their actions, and they must be willing to take responsibility when things go wrong. They must also be forward-thinking, able to anticipate potential challenges and devise strategies to overcome them. Lastly, the industry must focus on strengthening oversight. This means not only enforcing existing regulations, but also continually reassessing and updating these regulations in line with evolving market conditions and technological advancements. In conclusion, the collapse of Silicon Valley Bank should not be viewed merely as a tragedy, but as a catalyst for change. It's a wake-up call for the banking industry, a call to action. As we move forward, let's hope the lessons learned from this incident will guide us towards a more stable and secure financial future. Thank you for watching our video on the downfall of Silicon Valley Bank. We hope you found it insightful and informative as we delved into the intricate details surrounding the collapse and the lessons learned. If you appreciated the content and found it valuable, please do hit the like button below. This not only helps us gauge your interest, but also supports our work to bring you more such comprehensive content. We're passionate about sharing knowledge and insights on a range of topics. Our aim is to provide you with an in-depth look at a variety of different topics, their highs, their lows, and everything in between. If you haven't done so already, we encourage you to subscribe to our channel. By doing so, you'll be notified each time we release a new video, ensuring you never miss out on any of our fascinating content. As we conclude this video, remember, your support is what fuels our content creation. Your likes, shares, and subscriptions help us reach a wider audience, fostering a knowledgeable and informed community. So don't forget to like, share, and subscribe, and together let's continue to learn and grow. Once again, thank you for joining us on this journey.